Hi, I'm Eric Townsend, and I'm a hedge fund manager with Fourth Turning Capital. Back at the end of 2010, when I was still a private investor, I produced 2 free videos about peak cheap oil investing. The first video began with this bold prediction. I predict that the next major calamity the global economy will face will be much worse than the 2008 financial crisis, and will probably come sooner than anyone expects. That calamity will be a global energy crisis. 4 years later, we're in the middle of an outright revolution in shale oil production in the United States, accompanied by frequent promises from President Obama that we'll soon be energy independent. In light of these developments, it might appear that I got it all wrong. I'm producing this third video now in December of 2014 because I don't think I got anything wrong, and I stand by my original predictions from those 2 videos without reservation or hesitation, except for just one little detail. In the first video, I also said this. And I believe it will be upon us by 2015. So I said the crisis would be upon us by 2015, but now, 4 years later, as 2015 approaches, we're experiencing an epic sell-off to much lower prices than we've seen in years. So on the surface, it looks like I really blew the call. But in fairness to myself, later in the videos, I also said this. Getting the dates right is the hardest part of engineering a trading strategy for peak oil. Without a doubt, the shale oil revolution in the United States has delayed the onset of the peak cheap oil energy crisis, which I'm still predicting. And the big sell-off in oil prices now underway as this third video is being produced is actually very much in line with my original predictions. Recall from the original videos where I said this. The risk scenario I think most about is what I call the ACH sell-off. In other words, before the crisis window arrives, I think there could be a very dramatic downward correction in oil prices. There are several catalysts that could bring this about. Again, I was early on the timing, but the big sell-off that we're seeing right now is exactly what I was predicting when I described the ACH sell-off. As this video was being produced, West Texas Intermediate crude has already traded below $60 briefly, and I think it may have even farther to go to the downside. Exactly as I predicted in the first 2 videos, this sell-off will create the buying opportunity of a lifetime when it bottoms, and I'm more excited than ever about the trading opportunities I see on the horizon. So let's revisit some of my other predictions from 4 years ago. In the first video, I said this as well. We have until about 2020, less than 10 years from now, to find new sources of oil to fill this gap. Putting the numbers in context, we need to find the equivalent of 5 new Saudi Arabias in the next 10 years in order to solve the problem. Many observers seem convinced that the present shale oil revolution has provided exactly the miracle that I described. But I disagree. Quite to the contrary, the shale oil revolution has delayed the onset of a peak cheap oil-induced energy crisis by several years. But to say that shale oil has solved the problem amounts to ignoring the facts and evidence. The shale revolution bought us time, perhaps as much as 5 years, but nothing more. I'll substantiate that assertion very shortly. I also said that the next calamity that the global economy will face would be induced by peak cheap oil. Now that we have a delay in the onset of the peak cheap oil energy crisis by as much as 5 years, I see another potential macroeconomic disaster on the horizon which could occur before the peak cheap oil crisis. That other risk is a major dislocation in the U.S. Treasury bond market, coupled with a change in the U.S. dollar's role as global reserve currency. But that's a separate topic worthy of its own discussion, so I'm already working on another video to be released in early 2015, discussing that topic in full detail. You can subscribe to my mailing list on my website if you want to be notified when it's released. The remainder of this video will provide an update on the peak cheap oil situation described in the first 2 videos. The content in this video builds on those first 2 videos, so if you haven't already watched them, please stop here and watch them first. You can find the free download links for the original 2 videos on my personal website at www.erictownsend.com. Recall this chart from the first video. It was originally published in the 2009 World Energy Outlook Report from the U.S. government's Energy Information Agency. The chart shows existing conventional production projects declining from about 86 million barrels per day back in 2009 to only 43 million barrels per day by 2030. Using EIA's 2030 global demand projection of 105 million barrels per day, that leaves 62 million barrels per day of present-day production capacity from existing conventional resources that will be lost to production declines in existing oil fields, and which will therefore need to be replaced by new sources of oil production before 2030. Because it generally takes about 10 years to develop an oil field, from initial discovery to full production, I concluded that we only had until 2020, just 5 years from now, to find the equivalent of at least 5 new Saudi Arabia's worth of crude oil production in order to meet projected demand. Back in 2009, when this chart was first published by EIA, it looked like the gap between existing production and expected demand would start to open up around 2012, creating a supply deficit that would have been upon us by now, according to this chart. Without a doubt, the shale oil revolution in the United States has been our savior. The most optimistic projections imply that by 2020 we'll be producing more than 5 million barrels per day of domestic shale oil. Add that to the pre-existing domestic conventional production, and within 5 years, many analysts predict the United States will eclipse Saudi Arabia as the world's largest oil producer, with some estimates as high as 12.5 million barrels per day of total domestic oil production by 2020. I think those predictions are entirely plausible, and I'm delighted that the miracle of shale oil arrived just in the nick of time. The big sell-off in energy prices in late 2014 may force the U.S. shale oil revolution to be put on hold until prices recover, but we're going to need all of that oil sooner or later. But hold on. As I described a few moments ago, in order to solve the 2030 peak cheap oil problem on a global scale, we need to find at least 62 million barrels per day, or about 5 Saudi Arabia's worth of new oil fields by 2020 in order that they could be put online by 2030. The U.S. shale oil revolution is realistically going to deliver 5 million barrels per day, or about half of 1 Saudi Arabia worth of new production by 2020. So the question to ask yourself is, where are the other 4.5 new Saudi Arabias that we need to find in the next 5 years going to come from? So if that's the case, why don't we already have a crisis on our hands? Look at the highlighted area of the original chart from 2009, which shows how much oil deficit was expected to occur by the beginning of 2015. At that point in the chart, it's not very much, and the shale oil revolution provided more than enough oil to fill the gap, for now anyway. But in order to keep up with the exponential growth of the wedge of hope in this chart, we need to find more miracles on at least the scale of the shale revolution, and we need them both soon and in exponentially growing number in order to meet the projected 2030 shortfall. Shale oil bought us a few more years. If we can somehow use that time, at most 5 years in my estimation, to invent technology that somehow enables the equivalent of 11.4 more shale oil revolutions by discovering and developing the equivalent of 4 3/4 more Saudi Arabia's worth of new oil fields before 2020, just 5 years from now, then the problem will be solved. But short of that happening, we still have a problem, Houston. You might be wondering, if I still see such a huge problem on the horizon, then why has the second half of 2014 seen an epic sell-off in oil prices to lows that haven't been seen in years? Well, there's an old adage among oil traders. The price of Brent crude can trade below $100, but it can't stay there very long unless Saudi Arabia wants it to. The reason is that Saudi Arabia is known as the swing producer, meaning that the Saudis can cut back their production quotas in order to support higher prices. At the time of this video production, many analysts believed that Saudi Arabia was intentionally targeting much lower oil prices in the United States for the express and intentional purpose of making it uneconomic for the shale revolution to continue. The apparent attack on the shale drillers is perceived by some analysts as an intentional move by Saudi Arabia to maintain its market share in the United States and to force the shale revolution to be derailed, eventually leading to much higher prices while Saudi Arabia maintains its market share at those higher prices for a considerable time before the shale revolution can eventually be restarted. At the time of this video production, it was not yet clear whether that was really Saudi Arabia's motive and the cause of the deep price correction. But one way or another, the ACH sell-off I described in the original videos from 4 years ago is now upon us. For several years now, the market has been thoroughly immersed in a mindset that I've termed SOSE, S-O-S-E, for shale oil solves everything. The exceptionally impressive short-term increases in domestic production, thanks to the shale revolution, have hypnotized the entire market. Entirely realistic predictions of the United States eclipsing Saudi Arabia as the world's largest oil producer appeal so much to our emotions that most market participants seem to have forgotten that we needed to find 5 times Saudi Arabia's production in order to solve the long-term peak cheap oil problem globally. I've literally had investors laugh in my face when I tell them that I believe peak cheap oil is still a big problem, because so many of them are ignoring the actual data and assuming that the United States eclipsing Saudi Arabia as the world's largest oil producer would somehow solve the global peak oil problem. But it won't. And now that oil prices have sold off so dramatically in late 2014, many people interpret the sell-off as confirmation that shale oil does indeed solve everything. In fact, I've seen some projections of oil prices in the $40 range for decades to come. Before the sell-off, which is now underway, began, I thought the tide might have changed already on SOSE back in February of 2014. This is a long-term chart of the December 2020 West Texas Intermediate Crude Oil Futures contract. I use this contract as a proxy for the market's expectations for oil prices in the distant future. Notice how a very steady, consistent downtrend carried the price of U.S. crude oil for delivery 6 years from now, in December of 2020, all the way down to below $74 per barrel, the February 2014 low. I'm convinced that this sell-off to a dramatic discount below spot price was driven by SOSE, the widespread expectation that shale oil would solve all our problems. Using this chart of the market's price expectations for very long-dated crude oil futures contracts, it could be argued that peak SOSE occurred back in February of 2014. It's no coincidence that this was about the time IEA announced its prediction that the United States shale oil boom would probably run out of steam sometime around 2020. Did we see peak SOSE in February of 2014? The onset of the ACH sell-off in late 2014 might at first seem to disprove that notion. After all, oil prices have been in freefall from late June 2014 until the date of this production in mid-December. But now let's compare the magnitude of the sell-off in front-month West Texas Intermediate crude oil futures from $107 all the way down to $60 at the time of this production to the much more modest sell-off of the December 2020 contract, which I use as a proxy for SOSE sentiment. The front month sold off $47 from its late June high to its $60 price at the time of this production. The long-dated 2020 contract, which I used to gauge SOSE sentiment, peaked a few days later than the front month on July 3rd at $88.72. It was trading at $71.46 at the time of this production. That's just over $17 of downside in the 2020 contract in a period where the front month sold off by $47. Now, long-dated futures contracts are almost always less volatile than near-dated contracts, but this contrast and extent of price decline is still striking. My conclusion is that the shale oil solves everything sentiment is losing its footing but may still have room to last a little bit longer. On the day we recorded this video, front-month West Texas Intermediate crude oil prices plunged to $60, and the long-dated 2020 contract that I used to gauge saucy sentiment took out its prior February low, trading below $72. But even though the 2020 contract has now reached a lower low, it's only $2 lower than the February low. On the other hand, the front month is trading $27 lower than it was back in February. Meanwhile, the term structure of the West Texas Intermediate crude oil futures market has reversed from record backwardation, which in my opinion was probably being driven by saucy expectations, and is presently moving back into structural contango. This chart shows the WTI term structure at the end of 2012. Here's June 2013. Backwardation steepens even more by December 2013 and reached its peak in February 2014. Since then, the forward strip started to flatten out, as shown here in the June 14 term structure, and here in the September 14 term structure. By December 14, the term structure had moved back into structural contango. The message is clear. The very deep backwardation that was being driven by saucy expectations is now coming back out of the market. Accordingly, the ACH calendar spread trade, which I described in the second video, has performed extremely well in recent months. One might argue that the return to contango was not caused by fading saucy expectations, but simply by the epic sell-off in the front-month futures contract in late 2014. I disagree, however, because the flattening of the term structure clearly began well before the peak in front-month prices in late June. The term structure had been flattening for several months by then, even as the front-month prices continued to climb towards their midsummer peak. If the reason for the shift to contango had simply been the weakness in the front end of the strip, the peak in backwardation should have been coincident with the late June peak in front-month prices. But it wasn't. Peak backwardation occurred in early February, just after IEA expressed skepticism about the long-term sustainability of the U.S. shale oil revolution. It's important for investors to understand that shale oil plays have very different economics and production profiles in contrast to conventional projects. Oilmen love the economics of shale oil wells because most of a shale well's production comes in the first 2 years, allowing the developer of the project to recoup his investment and move on to the next project without having to wait a decade or more for the investment to pay off. But too many analysts fail to recognize that this also means the long-term relevance of these plays is muted, because the supply they contribute disappears within 2 or 3 years after production begins. And that also means that if the Saudis succeed in shaking out the shale drillers with lower prices, assuming that's actually their goal, it would only take a couple of years to undo all the progress that's been made to date by the shale oil revolution. Investors have been acting as if the projections of 12.5 million barrels per day of total domestic oil production in the United States by 2020 is some profound new national endowment that will last for decades. In reality, the very steep decline rates associated with shale oil plays dictate that this new source of production could easily ramp down from 5 million barrels per day of new shale production back to zero almost as quickly as it was ramped up from 0 to 5 million barrels per day. Of course, it doesn't have to go back to zero. There will be plenty of opportunity to drill new wells and refrac old ones. But that costs money and consumes finite resources. Meanwhile, the ACH sell-off now underway could temporarily derail the shale revolution if prices stay below $60, the break-even point for the median shale operator. Such an outcome could mean that we lose the benefit of shale production for a few years, which would mean much higher prices later on down the road. Then those higher prices would enable the restart of the shale revolution, and then perhaps yet another sell-off would ensue once additional production came online. But the bottom line is that in the grand scheme of things, the shale revolution will ultimately be remembered as a flash in the pan. A whole lot of new oil production that came online very quickly and then disappeared just as quickly. perhaps in waves punctuated by Saudi Arabia's price policy maneuvering. I know it's tempting to conclude that the big sell-off disproves my prognosis of much higher energy prices in the future. But I want you to consider that this entire massive price collapse happened because the Shale Revolution created a supply glut exceeding demand by only about 1 million barrels per day. The point here is that even small imbalances between supply and demand can cause really big price swings. Right now we're experiencing a temporary supply glut of just 1 million barrels per day, and crude oil prices are outright crashing. The question I want you to ask yourself is what will happen when 60 million barrels of supply is destroyed by conventional production declines in the next 15 years, and we can't find and produce enough non-conventional oil to replace it? That's the operative question. Now I'd like to share my long-term crude oil price forecast. On the day this video was recorded, West Texas Intermediate tested $60 for the first time since 2009. The epic ACH sell-off now underway probably has farther to go. The lowest I could imagine prices falling would be down to the cash cost of production, which is about $35 for most operators. Below that figure, it actually makes more sense to shut in operating wells and cease production until prices recover. But I don't think prices will go that low. My prediction is that prices will bottom sometime in the first half of 2015, somewhere between $40 and $60. Whatever the price level, I think that bottom could be the last time we ever see prices that low. I won't be surprised if the coming period of low oil prices lasts as much as a year or two, but eventually prices will be headed much, much higher. The coming bottom, whatever the number turns out to be, will be the buying opportunity of a lifetime. Now let's debunk some myths associated with energy independence. The United States consumes approximately 19 million barrels per day of crude oil. In rough terms, 10 million of those barrels are imported from other nations, while 9 million of those barrels are domestically produced as of 2014. That 9 million barrel per day domestic production statistic is expected to grow to 12 million barrels per day by 2020, thanks primarily to the shale oil revolution. But according to IEA, shale production should peak around 2020, and further dramatic growth in domestic production owing to shale is unlikely. So for starters, given our 19 million barrel per day appetite for crude oil, moving from 9 to 12 million barrels per day is a marked improvement, but it still leaves 7 million barrels per day to be imported from other nations. I believe that those who are hopeful that shale production growth rates will continue indefinitely, eventually closing this gap so that the United States produces all 19 million barrels per day that it needs to run its own economy, will be disappointed. To the contrary, shale oil plays inherently involve extremely sharp production decline rates. A typical shale oil well loses 70% of its initial flow rate after just 1 year of operation, and as much as 90% by the end of the second year. I predict that even the widely accepted 12 million barrel per day domestic production target will only be sustainable for a few years at most. Then the shale revolution will have played out, and I predict that we'll see a decline back towards 7.5 or 8 million barrels per day of domestic production by the mid to late 2020s. Of course, it's entirely possible that some new technology development will be invented that will create a new domestic production revolution, just as multi-stage hydraulic fracturing and horizontal drilling yielded the present revolution. But that new technology will almost certainly come at a higher incremental cost of production. Recall this graphic from the first video. Peak oil, meaning the eventual moment where we reach the peak rate of global oil production, is still probably years into our future. New technologies will enable the discovery and production of new oil resources for many years to come. But these new oil sources will only be possible with ever-increasing technological complexity, and therefore ever-increasing production cost. Peak oil may still be a decade off, but peak cheap oil has been a present-tense reality for a full decade now, ever since conventional oil production peaked in May of 2005. Once the ACH sell-off, which was underway at the time of this video production, runs its course, We can expect oil to become more and more expensive as ever-increasing technological complexity is required to produce oil from exotic sources such as deepwater offshore, tar sands, and enhanced oil recovery techniques such as carbon dioxide injection. Let's return now to the topic of energy independence. American politicians love to pretend that just as soon as we find a way to domestically produce as much as we consume, suddenly all our problems will end and everything will be fine. But global markets simply don't work that way. Canada has produced considerably more oil than it consumes for many years now. Does this mean that Canadians enjoy lower prices for gasoline than U.S. consumers? No, quite to the contrary. The opposite is true. Canadians pay more for gasoline because their government taxes it more. The price Canadian refineries pay for their feedstock crude oil is approximately the same as all the other refineries around the world, because it's a global market in which prices are set globally. Now, Canadian refineries enjoy a small discount associated with lower transportation costs when they're consuming domestic oil. But the major component of price is the price per barrel before transportation costs, and that price is set globally. So as long as we continue to have a global economy structured around free market capitalism and free trade of commodities such as crude oil, the price will continue to be set globally. That means that in order to meet global demand, the production shortfall we need to focus on is not the 7 million barrels more oil that the United States uses than it produces domestically. Rather, the relevant figure is the 62 million barrel per day global shortfall this familiar chart predicts by 2030. The U.S. shale oil revolution has sourced 5 million of those barrels, solving 8% of the problem. Unfortunately, the 2020 shale production estimate of 5 million barrels per day from shale oil alone won't be sustained indefinitely and will probably have declined considerably by 2030. But for sake of discussion, let's pretend that 5 million barrels per day is a permanent endowment that will last forever, pushing U.S. domestic production permanently above 12 million barrels per day. Now the 62 million barrel per day shortfall is only 57 million barrels per day by 2030. And to be sure, there's room for shale production technology to go global. Not all oil fields are conducive to these extraction technologies, but clearly some are. So let's assume, for sake of argument, that global application of hydraulic fracturing and horizontal drilling could produce still another 10 million barrels per day by 2030, the equivalent of 2 more U.S. shale oil revolutions occurring elsewhere around the globe during that time. Now we're down to only 47 million barrels per day shortfall, or the equivalent of 4 more Saudi Arabias worth of new oil production that needs to be discovered in the next 5 years so that it can be developed into full production in the following decade. I chose the number 10 million barrels per day for globalization of shale production because that's the fastest I can possibly imagine a ramp-up of shale production occurring by 2030. Remember, this requires a lot of specialized equipment that would have to be manufactured in the United States and exported, or else the technology for manufacturing it would have to be exported. But maybe you're more optimistic than I am, so let's double my figures and go with, let's say, 20 million barrels per day from a globalization of the shale revolution. Well, guess what? You still need to find 3 more Saudi Arabias in the next few years in order to make up the shortfall of 37 million barrels per day by 2030. Keep in mind that the ACH sell-off now underway makes shale oil production far less profitable, and that means that we can expect progress in the internationalization of the shale revolution to be slow or non-existent until after prices recover. I don't know about you, but I'm fresh out of ideas as to where those extra 3 or 4 more Saudi Arabias worth of oil production are going to come from. Please email me if you know the answer. Am I saying that we'll never find a way to produce the oil that we need to keep the economy going? No, to the contrary. I'm still a technologist at heart, and there's little doubt in my mind that we'll invent new technologies to find and produce the oil we need. In fact, there's a new developmental technology underway now that involves high energy lasers in the tip of drill bits in order to allow them to be more efficient while requiring less torque. But once again, the key point here is that all this new technology won't come cheap. All the cheap and easy to produce oil has already been found. The production rates for those projects are already in a state of decline. The new oil sources that replace them will be high-tech alternatives that cost a lot more to produce. The age of peak cheap oil is clearly upon us. Tying this back to energy independence, what all this means is that so long as we continue the paradigm of free international trade, the price of oil will be under upward pressure unless and until we find those 4 or 5 more Saudi Arabia's worth of oil that we don't presently have a source for. In the very unlikely event that the United States someday manages to produce even more than the 19 million barrels per day that it presently consumes, that fact will be exactly as irrelevant as the already true fact that Canada has produced more oil than it consumes for many years. The only way that producing as much as we consume becomes relevant is if we change the doctrine of free market capitalism and open trade of commodities internationally in favor of a protectionist system which reserves oil production for the countries in which it's produced. Now, I don't think that's entirely out of the question. Although I don't think United States energy independence is a realistic goal, North American energy independence is definitely within reach. I wouldn't be surprised if the United States were eventually to pressure Canada and Mexico to create a protectionist energy alliance in which it becomes illegal to export oil produced in North America outside of North America. Mexico could easily be wooed into such a deal by trading this concession for immigration reforms that are already popular with many American voters. Canada would be a harder sell, because if Canada can sell its oil to the United States for $90 a barrel or to China for $120 a barrel, it's obviously a better deal for Canada to deal with China. But I expect geopolitical tension with China and Russia to grow in coming years. In fact, I believe a new Cold War between the West and those nations is already in its infancy. So I think there's room for Canada to be persuaded that a protectionist North American energy alliance is in Canada's best interest from a national security perspective. Now, to be clear, I'm not predicting this protectionist outcome, nor do I endorse such a scenario myself. To the contrary, I'm a free markets kind of guy, and I think that this sort of protectionism would only serve to further alienate the United States from its global trading partners. But I can easily imagine President Hillary Clinton preaching to the masses about how she's going to give North America a profound economic advantage over the rest of the world while bringing back all those jobs that were shipped overseas in the 80s and 90s. While I would not personally support such policies, I think that message would sell incredibly well to the American middle class. My point in bringing up the hypothetical scenario of a protectionist North American energy alliance is not to predict that outcome, but rather to make a broader point. We can analyze the global energy market based on how it works today, and we get one set of predictions. Specifically, because commodities are freely traded globally, whether the United States produces more or less oil than it consumes will be categorically irrelevant as long as global demand exceeds global conventional supply. The price of each barrel of oil consumed in the United States will not be determined by the relationship of U.S. production to U.S. consumption, but rather by the relationship between global production and global consumption. This leads us down a risky path. It's tempting to say that peak cheap oil is such a clear threat to oil prices, and the current meme of shale oil solves everything complacency is creating a profound variance in perception between market expectations and actual reality. Overall, that's my base message, that we have a really serious global energy problem looming on the horizon, and that we're basking in complacency right now, because most analysts have failed to step back and look at the really big picture of global supply and demand. My point in bringing up the protectionist energy alliance scenario was not to predict that outcome, but rather to emphasize that the global free market system doesn't have to last forever. As we make long-term predictions about the direction of oil markets, it's important to keep in mind that geopolitical changes could easily undermine our most fundamental assumptions, including the assumption that oil is a fungible commodity whose price is set globally through free market price discovery. For now, the United States is still clearly the world's most powerful military force, and that military hegemony means that the United States can change the rules of global trade to suit its own best interests. But if the U.S. economy is dragged down as a result of growing energy demand from Asia in coming years, I won't be surprised if the United States asserts its power to change the rules of international commerce. Export of domestically produced crude oil is already prohibited by law in the United States, although this fact has remained largely irrelevant until now, because the United States has consumed far more than it produces for several decades. But as major geopolitical changes occur, the dynamics of free trade will change with them. Long-term investors will do well to open their minds to myriad possibilities as the U.S. dollar continues to gradually lose its reserve currency status and U.S. economic hegemony weakens in coming years. There are also interdependencies between the peak cheap oil situation and the other major macroeconomic risk that I see on the horizon, a major dislocation in the U.S. Treasury bond market. For example, if the ACH sell-off now underway at the time of this video production should derail the shale revolution temporarily, the resulting supply destruction will eventually lead to much higher oil prices. That may actually be Saudi Arabia's goal in allowing prices to fall as low as they already have. But the resulting future upside price shock could trigger inflation, tying the Fed's hands and precluding more quantitative easing. But those are topics for another video dedicated specifically to that subject. I'm working on that video now and will announce its release through my email list. You can sign up for free at www.erictownsend.com. To summarize this video, my view is that the crisis has been postponed by several years, but has not been averted. The peak cheap oil problem is as real as ever. We still need to find 62 million barrels per day and bring that new oil production online by 2030 in order to make up for declining production from existing conventional resources. The U.S. shale oil revolution will only supply 5 of those 62 million barrels of needed production, but it came to us just in the nick of time before the wedge of hope expands to daunting proportions. Here at the end of 2014, we're still in the first few years of this chart, where the wedge is narrowest, so oil from the U.S. shale revolution neatly fills the gap, and then some, but only for a few more years. Eventually, the U.S. shale boom will peak out and fall into decline. The wedge of hope will still be expanding, and there won't be enough new production to fill the void. The shale revolution bought us a delay of several years before the onset of a peak cheap oil energy crisis, but it's still coming sooner or later. Peak shale oil solves everything sentiment, my measure of market complacency relative to the impending energy crisis, may have passed in February 2014. Deep backwardation in the term structure of crude oil futures was almost certainly the result of widespread expectations of crashing oil prices in coming years, and that profound backwardation has now faded back out of the market, which has returned to a condition of modest structural contango. What remains to be seen is how long the U.S. shale oil boom can be sustained, because when it falters, we're going to see another big jump in oil prices, and the resulting inflation may be enough to put the Treasury market at great risk. So thanks for tuning in, and be sure to sign up for a free subscription to my Peak Oil Investor newsletter, as that will be the medium through which I'll communicate updates to the material presented here. You can sign up for free at www.erictownsend.com. I'll also be keeping you up to date on how my prognosis is shaping up through my weekly commodities reports on the Financial Sense NewsHour podcast, which you can subscribe to for free on iTunes or at www.financialsense.com/newshour. Thanks again for tuning in, and I hope you enjoyed this video.